first of two inflation prints this morning. What does it mean? We got to talk about the Atlanta Fed acknowledging that some of their employment data is out of whack. We can talk about some office and hotel delinquencies. But first, let me start with a conversation that Matt and Dion and I had yesterday. During that conversation, we went round and round about motivation, helping folks. But at the end of the conversation, something dawned on me about BiggerPockets. I believe, as I've shared, that BiggerPockets is going through kind of a back to the future. I believe BiggerPockets is going to pivot away from the needle in the haystack story, the 24-year-old with 200 units or, somebody who bought 80 units in 2 years and all of those kind of not repeatable stories. It is my belief, maybe it is my hope, that BiggerPockets goes very much back to how to get started. It's hard out there. Let's talk about getting your first, your fourth. Let's keep it real. Let's keep it about the people. As I said in that video yesterday, I believe if BiggerPockets goes that route and they focus on the largest part of the investing pool, that BiggerPockets, given their platform, given their reach, given their marketing machine, they could grow the middle class. As I shared in that video, something my mother has told me for 5 years now. Shout out, Dorothy. How you doing? Hope you're having a great day. She has told me repeatedly, almost every conversation, that what we're doing here at One Rental at a Time is growing the middle class. To which I chuckle. It's a nice thing to say. I don't see it, right? We are few and mighty, but we do not have the reach. We don't have the army. We just don't have the bazooka that BiggerPockets has. So I suspect if BiggerPockets goes that route, that in very short order, we could really strengthen the middle class. And I think that is a good thing. I think home ownership via house hacking, 203K loans, VA, FHA, however you get in, is a way to build wealth. I don't know how to argue the numbers that owning assets is a way to build wealth when you own them long term. So maybe it's a hope, maybe it's a dream, maybe it's hopium, I don't know. But for whatever it's worth, I hope BiggerPockets aims their attention, their name, their brand, their reach at growing the middle class. I think that is an awesome goal. So I wanted to share that epiphany, that light bulb moment that I had yesterday talking to Matt and Dion. I want to wish the BiggerPockets team all the best to make that happen. I think that would be a good thing for America. It would be a good thing for the world if we could grow the middle class instead of, the rich get richer and everybody else suffers. So again, that is a hope. I hope they take that opportunity in this time of transition and they just go for it. I think it is a worthy goal. All right, let's talk about inflation. Again, we got the first of two inflation readings this week. Let's call this one the baby inflation print because 95% of the attention will be on tomorrow. Tomorrow is CPI. Today was PPI, Producer Price Index. We get 4 readings. Remember, we have month-on-month, year-on-year, headline, and core. We get 4. Let's talk about headline first. Headline month-on-month came in at 0.1. It was expected to be 0.2, lower than expected. All right. How about headline year-on-year? Came in at 2.2, expected 2.3. Again, we are 2 for 2 in beats to the downside. How about core month-on-month? This is a big one. Was expected to be 0.2, came in at 0. That is a big beat to the downside. What about core year-on-year? Again, big beat. Expected to be 2.7, came in at 2.4. So folks, we had 4 for 4 beats to the downside. As you know or have likely heard from me, core is the most important versus headline because you can strip out things the Fed can't impact. And both of those year-on-year and core numbers were significant beats to the downside. This number standalone in a vacuum makes rate cuts in September more likely. But let's be serious. We won't know until tomorrow. If CPI comes in at expectations or hot, this number will mean nothing. If CPI comes in low, this number plus CPI will make September very likely for rate cuts. So we will find that out tomorrow. Folks, you have heard me talk about a buyer's market. You have heard me talk about a buyer's market. And I had a conversation with Casey from Brick by Brick Wealth yesterday. That is the perfect example of what I hope all of you are doing. Again, this is how you do it. Casey, awesome, great job. I thank you for being here every week and leading by example. So here's the story from my memory. You can go back and watch the video for yourself. Casey had a property brought to her in a slightly new area that she did not know much about. She went out there, she checked the market, she liked it. It was an A area. This particular property in her area was listed for $240,000. At $240,000, it would be very, very tough to cash flow. After about 3 weeks and no interest, the sellers dropped the property to $219,000. Folks, in my world, that is called a signal. A signal. 3 weeks in, they take, roughly speaking, a 10% haircut or $21,000. Okay? $219,000, Casey is still watching. She's like, ooh, that's a pretty significant price drop. Let's see what happens. Let's give it some time. A week later, still no interest. So Casey, after doing some more research, decides to write what I consider a disrespectful offer. And I hope you do as well. She wrote it for $204,000 and asked for 2% closing cost credit, which is another $4,000 that the sellers would have to give up. So basically, again, it started at $240,000. She's going to get into this $204,000 with 4%. And she asked for an inspection report. During the inspection report, she finds more stuff. She gets the seller to go down to $202,000 with 2% closing cost credit. Folks, this is the perfect example of a buyer's market. What do I mean? Remember. You make your money when you buy. In a buyer's market, it is easier to find motivated sellers. Why were these sellers motivated? Well, as Casey shared in the story, it found out that the sellers had a most important thing called a closing date. The price was not the most important thing. In this example, the sellers had already purchased a second home and they needed cash from this property to use as a down payment. So they were date bound. So they were motivated. Folks, again, motivated sellers are out there. They are easier to find in a buyer's market. It takes work. It takes luck. It takes offers. It takes follow-up. It takes being focused and having daily discipline. So Casey, thank you again for sharing your story. You're an amazing millionaire contributor on the show. I appreciate our conversations every Monday. Do what Casey did. Find properties with long days on market. Do the numbers. And write great offers or disrespectful offers, whatever makes you feel better. All right, let's talk about employment. One of the things that we have undoubtedly seen is a divergence in payroll reports, one with employees and one with employers. Well, the Atlanta Fed came out with something that I thought was market moving, although it didn't really hit the airways as much as I thought it would. Atlanta Fed says the payroll survey has likely overstated employment by 440,000 jobs. Let's just round that to 500,000. That is significant. Maybe Danielle DiMartino Booth is going to be right. Maybe this recession, this rolling recession, maybe it will be identified as, I think she said October of 2023. I cannot believe that the Atlanta Fed has put that out there, 440,000 jobs overstated. and not worked to back that data out. A little bit about office and hotel vacancies. It looks like office vacancies, or not vacancies, excuse me, delinquencies has spiked yet again. Office delinquencies now at a season high of 8.11%. Yes, what is that? 1 out of 12 properties are now vacant or in delinquent. I keep saying vacant. It's delinquent. Mortgage is delinquent. Also got to note that San Francisco hotels has an impressive delinquency rate. They tell office to hold my beer. The hotel delinquency rate in San Francisco is 41%. 41.6% to be exact. That is basically 1 out of every 2 hotels in San Francisco has debt that is delinquent. And in case you want to know, that's not good. Don't know if you saw the shakeup, but we've got some CEOs changing companies. Looks like the CEO of Starbucks is out. He has been the CEO, I think, for about a year. He has run the ship and had 2 negative quarters of growth. He is out. Looks like Starbucks probably paid a pretty penny to get the CEO of Chipotle. He has moved. Brian Niccol, I'm going to guess his name is, will become the CEO of Starbucks on September 1st or October 31st, depending on the day. So again, Starbucks gets a new CEO. Chipotle now looking for a CEO. So we had a conversation with the Hub yesterday in Fresno. That is my team out in Fresno. And I want to give Patrick Kim a shout out today because he dropped a nugget that I want all real estate agents to look at. If you're a real estate agent and you have access to the MLS, I want you to do the same search that Patrick Kim gave us yesterday. It is median sold and median listed, median active. This was wild. Median sold in Fresno, California, roughly is $440,000. Patrick Kim yesterday said the median home price of active listings, $570,000. Now, folks, what can explain that? Solds are $440, listings are $570. Well, in my opinion, there's only one answer. We have that bifurcated housing market. We are not getting the inventory of the first-time homeowners. They're staying put, as we have learned. And now we are seeing signs that the bigger homes, the luxury homes, are just sitting. Again, this is what is going on. Now, what could happen if you have a median sold at $440 and a median list at $570? It is not out of the realm of possibilities that median home prices might be yanked higher because of inventory mix. Yes, if you take the expensive homes, look, folks, it's math. If you have active listings at median at 570 and you drop them 10%, that is 520. 520 is more than 440. So again, we could have more price cuts, more drops, and still yank the median home price higher. That is how math works. We have lost the low end. We have lost the quantity, but we are getting more above the median, which is it's a sign that the housing market is just flat out broken. The housing market is broken. Alrighty, folks, we got earnings from Home Depot. Home Depot was a darling during the pandemic. Everybody was coming out, updating their houses and whatnot. It looks like the CEO and CFO do not have good things to say about the U.S. consumer. Looks like greater macroeconomic uncertainty pressured by consumers' demand, and they lower their forecast. CFO says customers defer not only because of high interest rates, but also because of greater uncertainty. Folks, again, I think the second half of this year is going to be remarkably slow. I think the average consumer is scared, pissed off, nervous, upset, whatever you want to call it. And when the average consumer is in that state of mind, they do not spend. Again, lots of things going on out there. Any other closing thoughts? No. Oh, let's do Mike Simonson, Altos Research. Again, we want to talk about Mike once a week. Team at Altos Research puts out amazing data. What is going on with active listings? while active inventory is up 1.3% month on month. That is 40.2% year on year. Pending home sales, right about the same, 367,000, same as last year. Prices of new listings, 410,000. That is up 2.8%. However, prices of pending, right? There's a lot of data, dude. Altos Research puts out amazing data, but you really got to watch the data line so you don't get confused. New listings, 410. Pendings, right? Ones that have gone pending, 389, down 4% year on year. And price cuts right now, statistically high, 39.7. Historical average is 33.1. So again, we are definitely above normal, although slightly down. I think last week was 40%, but still lots of price cuts. Folks, hear me. It is a buyer's market. Now, there are lots of people who have listed their home who are going to say, hey, if I don't get my, in Casey's case, 240, I'm not selling. Great. That is a stale listing that will expire and go away. But there are people, I don't know if it's 10% or 15% or shoot, 33%. It's some number of listings are just like the one Casey found. Listed at 240, she got it for 202 plus 2% closing cost credit. Lots of you don't think that's possible. Hogwash. Do the work, write the offers, follow up, focus, daily discipline. If you do the work, you will eventually find your motivated seller. And trust me, 23 years of real estate investing, you want to buy from motivated sellers. Always use 30-year fixed rate financing. Always make sure it cash flows so you can hold for a decade. And then your chances of getting wealthy are pretty certain. Have a great day. Like, subscribe, comment. We'll talk later. Bye.